920 short straddle, one of the most popular strategies of 2020, has stopped working in 2023. This strategy is a simple intraday bank nifty strategy where at 9:20 a.m. you create a short straddle by shorting a call option and a put option. And this strategy popularly prefers keeping a stop loss of 20% for each of the legs, and if one leg hits the stop loss, the other one is going to decay, or if none hits the stop loss, so both are going to give us profits. This strategy became extremely popular in 2020 because of the very high returns it generated in the period. If we actually backtest this strategy from 2017 and take a look at it, this strategy has given us a return of 400% in 6 years. And this is the reason why the strategy became so popular around the time of 2020. And when we look at the data year-wise, this strategy consistently returned close to around 40% plus CAGR between the period of 2017 and 2020. And during the period of 2020 and 19, this particular strategy gave more than 100% returns, or it doubled the capital in the same year. This strategy, which was doing so well all this while, suddenly stopped working. When you take a look at the 2023 performance, the performance of this strategy is just around 2%. So what really went wrong? That is what we are going to find out in this video. Before starting the video, we have to try to understand what led to the popularity of 920 short straddle. So there were three main reasons why people started moving in and creating short straddle, and the very first reason is introduction of backtesting. So before 2020 or 2019, so people didn't really have avenues or platforms to backtest any kind of strategy. Even though there was data available, people couldn't really code and do any kind of backtesting. Stockmock was one of the first platforms to introduce backtesting, where a retail user like you and me could simply go put a simple strategy and backtest and see how the strategy was working. So while this got introduced, even simple strategies like short straddle, short triangle, by keeping a simple stop loss, when we backtested, started to give exceptionally high returns. So this is when people started to feel, okay, why exactly should they break their heads in doing some complicated strategy analyzing market when simple short straddle strategy, doing it on an intraday basis, is delivering over 40% CAGR. So I'm pretty sure, including me and you, would have felt this at some point of time. It is much easier to do simple intraday system trades rather than trying to break our head analyzing the market. So this was one of the reasons. And the second reason which complemented this is increase in the number of people who came into markets during the time of 2020. Because of COVID, a lot of people were free, and this led to an influx of huge number of traders coming into markets and doing option selling. So let me just show you a simple Google search trend on how the option selling trend picked up during 2020. So now when we take a look at the Google search trend, you see right over here, before 2020, there was not really much search about option selling. So we are looking option selling as a search trend on YouTube. So you can see during the time of 2020, there was a sudden surge in the volume of search queries for option selling. When we take a look at the web, so I am only searching in India region right over here. And even in the web, you can see that there was sudden spike in the total number of queries for option selling during the time of 2020. So this also brought in a lot of people who were doing regular jobs into option trading, and all of them chose option selling. So this was the second reason. And the third reason, which was the most important reason, when these people started coming into the markets, they saw that simple strategies like 920 short straddle has delivered well over 40% CAGR in the last 3 to 4 years. So now, why exactly would you want to break your head and try to build a strategy when simple strategies like this have delivered such good returns? And this was one of the reasons where we saw huge influx of traders coming in and creating the same strategy and running it over and over again. And this is how the entire system trading, or for that matter 920 short straddle, started to gain its popularity. So now when you actually take a look at the overall backtested data from 2020, you can see that every year the edge of the strategy has come down. In 2020, it gave the highest returns of 126%, whereas in 2021, the returns dipped to 57%. In 2022, the returns dipped to 19%. So if you look at 2023 alone, this strategy has just given us 2% return. So you can see that from 120%, the returns have almost become nil. First, we will try to understand more statistics about this strategy, and later let's dive deep into what exactly caused this strategy to lose its edge. So the first thing is, here I have opened the 920 short straddle data, the same data where we have shorted ATM call and put and kept a 20% stop loss. So the thing what I have done right over here is to test for the last 1 year, that is 6th of December 2022 to December 1st 2023. So we are seeing last 1 year data, not from January but from December of last year. You can see this strategy has given us a negative 4% return. So a strategy which had given us overall 400% return this year hasn't given any return at all. Rather, it has given us a loss. So this is excluding brokerage. So when you include all of that, your loss is going to be much higher. So now what I'm also going to show you is the specifics of this strategy and how it has performed over the years. So let's start with 2017. So whenever you create a short straddle strategies with fixed stop loss, there are three outcomes. One, your both stop loss of calls and put side is going to get hit. The second outcome is one leg is going to hit the stop loss and the other one is going to decay. And finally, the third outcome where no leg is going to trigger the stop loss and you are going to make pretty good money. So out of these three, only one can happen. Let's look at the probability of these events happening from 2017 to 2023. And one more very important thing what we have to note is, whenever both the stop losses get triggered, so let's say the market goes up, hits your call stop loss, comes down and hits your put stop loss, you're definitely going to end in a loss. So there is no way that you can actually end in a profit because both of your stop losses have been hit. So when we take a look at how many number of times or what was the probability that both the stop losses were being hit in 2017, it was just around 27%. And similarly, if we see in 2018, it was 23% and 31%, 35%. But in 2023, the number has almost increased to 39%. So you can see that all the way from 27, on an average of 27 to 30%, we have now gone towards 40% where both the stop losses have been triggered. So that clearly shows that the edge of the strategy is coming down because the number of times both stop losses being triggered has increased. So you can take a look at the numbers right over here. In 2017, only 67% of the times the stop loss had triggered on both the sides, whereas in 2023, 96% of the times the stop loss was actually triggered on both the sides. So what we can also see is, whenever one stop loss is hit, generally the overall strategy has ended in a profit. In 2017, there was almost a chance of 70% that one stop loss was going to get triggered, but overall we used to end with a profit of 657. That is the average profit what we used to end per day. So now if we go to 2018, so you can see that the chances of one stop loss being hit increased to 72%, and overall profit what we would be making by one stop loss hitting also increased. So the average profit increased to 1057 per lot if one stop loss was triggered. And slowly you can see, once the strategy started to become more popular, and now coming to the main year, that is 2020-21, so 63% of the times one stop loss was hit. So whenever one stop loss got triggered, we made an average of 1333 rupees on that particular day. In 2023, what we get to see is one stop loss being triggered has decreased to 58% probability, and whenever one stop loss is hit, the average profit what we are making is just 752 rupees. So we are just going to ignore no stop losses being hit because hardly it has been around 2 to 3% of the times on an average when you look at year on year. So ignoring that, mostly you would have made the highest money if one stop loss is hit and the other one decays. So that is how this entire 920 short straddle strategy has made money till now. But if you look at it, the probability of one stop loss being hit is going down, whereas the probability of two stop losses being hit is going up. So now when we look at year-wise probability of ending with a profit in a single day. So in 2017, 60% of the days we ended with a profit. In 2018 to 19, 70% of the times we ended in profit, and 2019 to 20, 61%. So you can see from 2020 to 21, the probability started decreasing. For the first time since 2017, the probability of this strategy making profit has dipped below 50%. And this is really concerning, or it has just come to 50% from all the way to 60 to 70% once upon a time in 2017. And not just that, you can see that the risk to reward of this particular strategy had always been above 1. So in 2017 to 18, it was 1.3, same in 2018 to 19, 1.3. And slowly from 20 onwards, the risk to reward of this strategy started to dip. It came to 1.2, 1.1, and finally 1. So you can see what exactly has happened from this. The risk to reward of this strategy is exactly 1, and the probability has also become 50%, which means there is no edge in this strategy anymore. But what is the main reason which caused this issue in 920 short strategy? So this entire thing can be understood with two aspects. The very first aspect is a concept from economics known as the demand pull inflation. So let me give you an example of Bitcoin. So during 2020, we again saw huge rise in Bitcoin. So people started mining. So a lot of people wanted to buy computers, buy graphic cards to mine. So at one point of time, what ended up happening is the cost of having the setup and running the computers exceeded the reward what you used to get from mining a Bitcoin. So this was the effect of demand pull inflation, where the prices of all your graphic card, prices of setting up your entire system went up so high because of the huge demand. So entire cost reward opportunity started to diminish, because one side the cost of doing that started to increase, whereas on the other hand you didn't get proportional increase in the reward for doing it. Eventually everything leveled out and it was no longer lucrative to mine a Bitcoin because the cost of mining shot up more than actually getting a Bitcoin. We can also see a similar example in 1890s during the Alaska gold rush. There was a news around the time of 1890 that gold has been found in Alaska, and every single person who was around wanted to go and mine that gold. So eventually the cost of going to Alaska and getting the tools necessary to mine the gold started becoming more expensive than how much you could really mine and get out of it. So people who actually were in the beginning were the only ones who could make profit, both in Bitcoin, both in case of the Alaska gold rush, and also in case of 920 short straddle. People who knew about it from the beginning, people who were doing it from a long time, could actually make use of it only during the time when nobody really knew about it. Once people started to get to know about it, a lot of people rushed in, and suddenly that lucrativeness where you used to make very high returns no longer existed. And a similar thing has happened with 920 short straddle. So there is a concept in market called as the efficient market hypothesis. That means if every single person around knows a particular thing, then that is no longer going to be any effective, because everybody would want to make use of that opportunity. Eventually that opportunity will no longer exist for anybody to make money out of this. So you can just Google efficient market hypothesis and you will get to know about that. So the concept is pretty simple. If every single person in this particular room knows about an opportunity where you can make profit, so everybody would want to do it. So it's a simple and easy way to make profit, right? So when every single person starts doing that, there is no longer the opportunity created, because you need people doing something else, or you need people doing opposite of that to create an opportunity, right? So this is the second reason. As and when more and more people started talking about it and more data was available regarding 920 short straddle, so market started to become more efficient, and the opportunities what existed by creating this short straddle started to diminish. So this is not just happening with 920 short straddle. So there are multiple evidences how opportunities have been lost once people started to get to know about it. The very simple evidence is with respect to the January effect. So once upon a time, it became very popular that during the end of December, all the mutual funds will generally book returns and the stock price is going to come down. Whereas in January, they will start purchasing the stocks again and the stock price is going to rise. So there was a significant statistical evidence to prove that during the month of December, the stock prices used to dip, and during the month of January, the stock prices used to increase. And these are especially small cap and mid cap stocks. And this is popularly known as the January effect in the market. So you can again Google about it. And this effect started to diminish when more and more people started to know about it. And I'm pretty sure even you would have heard about this effect called as January effect. So when during the month of January, people usually tend to believe the stock prices is going to go higher. This used to happen till one point in time when not many people actually knew about it. So the second example was a study by Morningstar. So Morningstar showed that whenever any particular mutual fund is performing really well, so this particular fund's performance is going to come down over the next few years, because this fund is going to see a huge capital inflow. And whenever they see a huge capital inflow, they will be forced to invest or forced to buy stocks at a higher price, and this is going to bring down their returns. Again, you can see this is very similar to the strategy. So if a particular strategy is giving a lot of returns, a lot of people are going to do it. Similarly, if any particular mutual fund is giving you a very high returns, a lot of capital is going to come to it, and you're not going to find similar returns moving forward, because they will be forced to invest that capital in the market even though the market is at a very high rate. The third study goes back to the year of 2000, when high frequency trading was introduced. So high frequency trading, when it first got introduced, again was a very profitable business to do. So not many people had, first of all, access to internet. Secondly, people didn't really have access to data, and this particular trading became really famous. Eventually, when a lot of people started to do HFT trading, again the arbitrage opportunity, or what you could make out of HFT, started to diminish. And the final example what we would be taking is the example of technical analysis between the period of 2002 to 2005. A lot of people started using technical analysis, and it became really popular, because till then there was no real concept of breakout or breakdown, and a lot of new concepts also got introduced in technical analysis once it started become really popular around 2000. But post that, the technical analysis didn't work the same way it used to. Previously, if you go before 2003, you can see that if any stock is breaking out or if any stock is breaking down, there was a very high probability that stock would actually continue to trend. So post 2007, 2008, so when a lot of people started to do technical analysis, we get to see false breakout. So where the stock is actually going to break out, but immediately it is going to reverse. So all this false breakout, false breakdown started to come once a lot of people started to use technical analysis. So you can see that whenever any person uses the same strategy over and over again, and when everybody in the room gets to know about it, the effectiveness of the strategy is eventually going to come down. So what is the conclusion of this video? The conclusion of this video is pretty simple. It is not that the system trades are not going to work anymore. So one thing what we have to understand is the effectiveness of any particular trade is going to come down when more people start using it. A simple example to this could be option buying and option selling. In 2017, there were not a lot of option sellers. By 2023, we see a huge number of option sellers coming into the market. And that's the reason making money by selling options in 23 is not as easy as it was in 2017. In 2017, you could simply sell any option, go to sleep. By the time you get up, this particular strategy or particular option would have gone down to zero. But things have changed in 2023, where you have to struggle or work hard to get that additional alpha. And similarly, you can see in technical analysis, it is not that the technical analysis has stopped working from 2008. Even today, there will be some points in time where technical analysis will work brilliantly, and people still rely on technical analysis to make their bet. So the entire concept of momentum trading again relies on technical analysis alone. So again, when we come to the HFT or high frequency trading, it is not that the HFTs have totally stopped working. So the amount of returns what they used to make maybe a decade ago versus what they are making now has considerably come down. So what this really means that we have to continuously be improving, and we have to work harder to get that additional edge. So now no longer a simple intraday short straddle by keeping a simple stop loss is going to work. So we have to work harder to get that additional edge. So it can be by maybe slightly trying to improvise your strategy by using different elements in your intraday strategy. One very important thing what we have to remember, so whenever you try to optimize your risk, your returns are automatically going to go up. Going forward, even in 2024, simple system strategies might no longer work. Or even going forward, option selling is not going to become any easier. So people still believe somewhere in their mind, so they will be getting back the 2017 regime sometime in 2024 or 25. To be honest, this 2017-18 regime is not going to come back for option sellers anytime, because if it is going to come back, a lot of people are going to jump back in and it is going to decrease the efficiency. So the video is more about discussing the effectiveness of any strategy. So no strategy is going to stop working. So the effectiveness of each strategy is going to come down. So right now you can see 920 short straddle has literally given no opportunity for the buyer, no opportunity for the seller. Neither have the sellers or the buyers made money in 920 short straddle during 2023, and this can again repeat going forward unless you try to bring in some edge in your strategy and try to improvise that. So this is the main reason why these strategies have stopped working anymore, and you have to try to improve your systems to make a better strategy which has slightly more effectiveness compared to simple short straddles. And I hope this video was informative and you were able to get some value out of it. If so, then don't forget to hit the like button, share this video, and subscribe to my channel. Thank you so much for joining, guys, and see you soon in the next video.